We're into part 2 of talking about the employee retention tax credit. In part 1, we talked about the revenue method or the gross receipts method to qualify. Right now, we're going to tell you about the second, which is government shutdowns. Now, this is the most complex of the 3 different methods in order to qualify. It's because there's not a lot of information. So you want to work with a professional to evaluate what it comes down to with your business. We can look at your sales, we can look at your employee hours, we can look at anything that hurt your business. And in order to do so, we want to look at 2019 as your base year, your last normal year. And then we want to look at what was taken away by government order in 2020 or 2021. We want to figure out how to separate your business up into fractions. And those fractions are going to be either based on revenue or employee hours. And so after we find these fractions, there's 3 things that you need to have in order to determine whether or not you qualify. The first is a legitimate government order that mandates that that fraction of your business was taken away. The second is we actually have to show that your business did shut down. And the third, whatever was taken away has to be considered nominal, which is more than 10% of the sum. So 10% of total revenue or 10% of employee hours. The reason this gets complicated is because there's a lot of people out there that just say, hey, my supply chain was impacted, I should qualify for the credit. But as you can see, there's more that we have to dive into. We're going to dive into our third part, talking about recovery startup businesses next. I hope you'll follow along. And for all of this information, I get it. There's a lot going on. Business owners need help. That's who I'm here to serve. So I look forward to coming and seeing you in part 3. I look forward to sharing my tax secrets with you. Let's get to work.